Why most people fail at getting funding. Business financing can be a challenge, particularly for startup companies. Lenders will understandably tend to be cautious. They want to be sure you'll pay them back. When it comes to business lending, there are several options. These include traditional lenders, which are often banks, online lenders, microlenders, and the SBA. Most business owners start looking for a loan for a certain amount, but they don't qualify. Many people are used to thinking of banks as where they get money. You can be well educated and still not have heard of lots of these choices for funding. Here's a short history of business financing. According to Wikipedia, banking in a primitive form goes back to Mesopotamia in the 5th century BC. Wikipedia also says the oldest bank still in existence is headquartered in Siena, Italy. It has been operating continuously since 1472. Wikipedia also says the term credit was first used in the 1520s, but the act of extending credit is even older. It goes back a good 5,000 years. Credit was even used before coins or cash were invented. Even George Washington kept a bar tab at Philadelphia City Tavern, according to the Thrillist. What's better than a bank loan? There are a lot of choices. As stated, these include online lenders, microlenders, and the SBA. Choices also include unsecured business financing, crowdfunding, revenue lending, angel investors and venture capitalists, factoring, business credit cards, inventory financing, and business credit. What can a business owner do? In many cases, there are credit cards or lines that can work well instead. What it really comes down to is getting money. Figure out what you need the money for. For example, if you need $10,000 for office supplies, $10,000 for furniture, and $5,000 for computers. So chunk it down and don't try to get one set amount. You might need to improvise and get funding from a lot of different sources. Fortunately, we know several. Let's look at some strategies for getting business financing. Consider your strengths. They might be good personal credit, or maybe you can get a guarantor, or maybe your product is revolutionary, or you might have the gift of being good at lining up investors. Work with your strengths. Online lenders have their own rules. Often the chances of getting financing depend on a combination of these factors: annual or monthly revenue, time in business, and your personal credit score and/or ability to give a personal guarantee. Sometimes lenders will want collateral. Forms and fees will vary. Let's look at microlenders. You can only get a microloan from a microlender. Try the Association for Enterprise Opportunity at www.microenterpriseworks.org. A microloan is exactly what it sounds like. It is not a lot of money. Still, if your business only needs something like $500 to $35,000, then a microloan could work. What about the SBA? Not every company can qualify for an SBA loan, but for those that can, there's a lot of paperwork before you get funding. They have various Caplines loan programs and SBA Express. They do not provide the loans, rather, the SBA sets loan guidelines. Their lending partners actually make the loans. The SBA also offers research grants if your company engages in research and development. How about unsecured business financing? These report to business CRAs, not personal CRAs. Proof of cash flow or collateral aren't needed. You don't need to fulfill a time and business requirement. All that matters is your personal credit. You need quality credit with no derogatory reporting. With a 650 credit score, you only get personal cards. With a 680 credit score, you get both business and personal cards. There is often a 0% introductory rate for 6 to 18 months, and then 5 to 21% APR with 20 to 25% APR for cash advances. You will only pay on what you owe, not like a loan. A lending source works to get credit cards for you. Often they can get 5 times what you could. Generally, this is 5 to 8 cards. They can also get low introductory rates, typically 0% for 6 to 18 months. Most sources charge 9 to 12% success-based fees. You will pay an average of 10% on the amount borrowed. All lenders on all loan programs charge fees. You easily pay 5% or more, even on an SBA loan. This program, like most others including SBA, roll in your fee, so you don't pay up front. Let's consider crowdfunding. Try a service like Kickstarter, but read the fine print, as they will take 4 to 10% of the donations. You may have to give all of the funding back if you do not make your goal by the campaign's end. Indiegogo has a flexible funding option, but it costs more. Straightforward business might not do so well. Products which aren't quite on the shelves yet, or artistic endeavors, can do well. How about securities-based financing? Use existing stocks as leverage to get business financing. Borrow up to 90% of the value of your stocks. You can keep earning interest on the stocks pledged as collateral. Closing and funding happen in less than 3 weeks. You get 70 to 90% loan to value, with rates as low as 1.6%. This is a working capital line of credit. Note, they will challenge your personal credit. Angel investors and venture capitalists might be a good idea. An angel investor will typically invest in early stage or startup companies in exchange for 20 to 25% return on their investment. Angels tend to invest less and also want less control than venture capitalists tend to. Venture capitalists will give money to help build up new startups, which the venture capitalists feel have both high growth and high risk potential. These can be fast growth companies with an exit strategy already in place. It's up to tens of millions of dollars for investment, networking, and growing their company. This is a gamble on future earnings. Venture capitalists will often look to recover their investment within a 3 to 5 year time frame and will also often want to own a piece of your company, if not a controlling stake. Let's take a look at factoring. Your company gets a percentage of outstanding invoices fronted by the factoring company. The factoring company then goes directly after any company which owed you money and collect on it themselves. This allows you to extend credit or negotiate longer-term payment plans in exchange for other, more favorable terms, like getting a retailer on board with your new company without holding a bunch of what are essentially IOUs for months at a time. Factoring can be very helpful when new companies are trying to establish relationships with their customers. Let's put business credit cards under the microscope. They must be paid off promptly, just like personal credit cards. If you apply with your Social Security number, then your personal credit score is at stake. And the credit card isn't helping you build business credit. But sometimes that's the only kind of business credit card you can get. If your business credit card is reporting to consumer credit agencies, then your card utilization rate matters a lot. If it goes over 30%, ideally more like 25%, then that will adversely affect your personal credit scores. Inventory financing is another option. You can use existing inventory as collateral. It must be valued at $500,000 or more. You can get approved for a line of credit for 50% of inventory value. Rates are usually 5 to 15%, depending on the type of inventory. Funding can happen within 3 weeks or less. The minimum inventory loan amount is $150,000. The general loan-to-value cost is 50%. So inventory value must be $300,000 or more. It can't be lumped together inventory like office equipment. Business credit is our hands-down favorite option. This is credit in your business's name and not your own. It starts with company legitimacy. That means a DBA, a professional website with email on the same domain, a toll-free number and a fax number on 411.com, and a professional business address. A virtual address is acceptable so long as it isn't a P.O. box or a UPS box. Regis is one company that sells virtual addresses. Start with starter credit. They can give you net 30 terms. Work with 5 to 8 vendors who report to at least one of the CRAs. Then move on to revolving store credit. With 10 revolving store credit lines reporting, move on to fleet credit. Got 14 fleet credit lines reporting? Then move on to cash credit. Good business credit will help you get loans in the future. Let's recap why most people fail at getting funding. Banks aren't the only place to get business funding. Viable options include online lenders, unsecured business financing, business credit cards, inventory financing, and business credit. Personal credit scores and time in business may determine some of your choices, but you don't have to put up your own money. Business credit in particular helps because it builds a foundation for borrowing in the future. Contact us today to learn more about why most people fail at getting funding.